$5,000 on a credit card at the average interest rate costs you roughly $90 every single month, just in interest. That's $1,075 a year that you earn nothing from. That buys you nothing. That is a subscription to debt. By the end of this video, you will know the exact math on what your balance is actually costing you, what the minimum payment trap looks like in real dollars, and the one move that can eliminate the interest entirely, if you qualify. If you've ever looked at your minimum payment and thought, that seems manageable, hit like. I'm about to show you what that feeling is actually costing you. Cards Made Simple is where we do the math on credit cards so you don't have to guess. Every rate, every fee, every bonus, we verify it and show our work. If you're new here, subscribe. We publish 2 Card Tuesday, Fine Print Wednesday, and Final Call Friday every week. You're paying the minimum because the bank designed it that way. The minimum payment is the most profitable product the credit card industry has ever invented. The interest accrues daily, not monthly. Every 24 hours you carry that balance, the number gets slightly bigger, silently. And the minimum payment is specifically calculated to keep you in debt as long as possible. Long enough for the bank to collect 2, 3, or 4 times what you actually borrowed. That's not a conspiracy theory. It is math, and we are going to do it together right now. The average credit card APR in the United States, measured across accounts actually being charged interest, sits at approximately 21.5% per Federal Reserve G.19 consumer credit data. That is still near the historic highs of the past few years. The average American credit card balance is approximately $6,300. What that means in practice? The average American carrying that balance is paying roughly $113 per month purely in interest charges. $6,300 times 21.5% divided by 12. Money that has 0 return, builds 0 equity, and buys 0 points. We built a complete interest model for 5 different balance scenarios. We calculated the minimum payment trap math, and we identified the exact balance transfer strategy that eliminates or dramatically reduces that cost. Part 1 of 4, the interest math. How bad is it really? Let's do the math correctly, because the way interest actually works is not what most people think. How credit card interest is calculated. Credit cards charge daily periodic interest. The formula is daily rate equals APR divided by 365. At the 21.5% average APR, daily rate equals 21.5% divided by 365 equals 0.0589% per day. On a $5,000 balance, daily interest equals $5,000 times 0.000589 equals $2.95 per day. Monthly interest equals $2.95 times 30.4 average days, approximal $90. So, $5,000 at 21.5% APR costs you approximately $90 in interest in the first month alone. Now, here is where it gets worse. That $90 gets added to your balance. Next month, you're paying interest on $5,090. The month after, on $5,181. This is compounding working against you. Different balance scenarios. Monthly interest cost at 21.5% APR. Balance times 21.5% divided by 12. Balance, monthly interest, annual interest cost, $1,000, $17.92, $215, $2,500, $44.79, $537, $5,000, $89.58, $1,075, $10,000, $179.17, $2,150, $15,000, $268.75, $3,225. If you have $10,000 on a credit card at 21.5%, you are paying $179 every month in interest. That is a car payment for a car you already bought, probably years ago. Part 2 of 4, the minimum payment trap, the actual math. This is the section the banks really don't want you to see. Let's model a $5,000 balance at the 21.5% average APR with a typical minimum payment structure. Most minimum payment formulas are 1% of balance plus interest charges, or a flat minimum, often $35, whichever is greater. Scenario: $5,000 balance, 21.5% APR, paying minimum only. Starting minimum payment, approximately $140 a month, 1% of balance plus the $90 monthly interest. At that rate, paying only the minimum. Time to pay off, approximately 16 years and 4 months. Total interest paid, approximately $7,500. Total amount paid for your $5,000, approximately $12,500. You borrowed $5,000. You paid back $12,500. The bank kept $7,500 as pure profit. What paying $300 a month instead looks like. Time to pay off, approximately 20 months. Total interest paid, approximately $1,000. Total amount paid, approximately $6,000. Money saved versus minimum payment, approximately $6,500. The difference between paying the minimum and paying $300 a month on a $5,000 balance, $6,500 and more than 14 years. That is what the minimum payment is designed to obscure. Drop your current balance in the comments and I'll walk you through the real payoff timeline. Before we get to the solution, if you want to know exactly which card fits your situation, including whether a balance transfer card makes sense for your balance, I put together the card match guide at cardsmadesimple.com/match. It's a 90-second quiz. It tells you your best card based on your spending and your current debt situation. Free. Link in the description. Part 3 of 4, the balance transfer option. Exact math. Here is the move that can eliminate or dramatically reduce the interest charge. The balance transfer. A balance transfer moves your existing balance from a high interest card to a card with a 0% introductory APR period. Some cards currently offer 15, 18, or 21 months at 0%. The math on a balance transfer for a $5,000 balance. Typical balance transfer fee, 3% to 5% of the amount transferred. On $5,000, 3% fee equals $150 upfront cost. 5% fee equals $250 upfront cost. Compare that to carrying the balance. Month 1 interest at 21.5% APR, $90. The 3% transfer fee, $150, is covered in the first 1.7 months of avoided interest. Over an 18-month 0% promotional period, you avoid approximately $1,600 in interest on a $5,000 balance, 18 times $89.58 before compounding. Net savings after 3% transfer fee, approximately $1,450. The critical rule: you must pay off the transferred balance before the promotional period ends. When the 0% period expires, the standard APR kicks in. And if you have a remaining balance, you are back at 21.5% or worse. Who the balance transfer works for. You have a specific balance you can realistically pay off within the promotional window. You qualify for the new card. Typically requires good to excellent credit, approximately 690 plus FICO. You can commit to not adding new charges to the new card during the payoff period. Who should skip it? If you can't make a plan to pay off the full balance before the promo period ends. If you're likely to use the new card for additional spending, the transfer becomes a trap. The best current balance transfer offers, including the specific promotional periods and transfer fees, are linked in the description below. Part 4 of 4, the hidden costs they actually don't tell you. 3 things your statement does not prominently disclose. 1. Interest accrues daily, not monthly. Your balance compounds every single day. By the time your statement closes, you've already been charged 30 days of daily interest. The monthly charge on your statement is 30 days of daily compounding. 2. Paying the minimum does not reset the daily rate. If you carry any balance, even $1, you lose your grace period. From that point on, new purchases start accruing interest immediately, not after your statement closes. 3. Cash advances have no grace period and typically higher rates. A $500 cash advance starts accruing interest from day 1, and cash advance APRs typically run higher than purchase APRs, often 29 to 30%, which is roughly 40 cents per day on $500. There is no grace period for cash advances. Here's the verdict and the action plan. If your balance is under $5,000 and you have good credit, run the balance transfer math. The 3% fee pays back in month 2. You need a card with a 0% promo period of at least 15 months and a realistic payoff plan. The best current offers are in the description. If your balance is over $10,000, the balance transfer alone may not be enough. You may need to address both the interest rate and the payment amount. This is where the math on debt consolidation loans versus balance transfers becomes relevant. This video covers the balance transfer option. Consolidation loans are a separate video. If you're currently paying the minimum on any balance, stop right now. Calculate what the minimum payment is costing you using the formula we walked through. Then set the highest fixed payment you can sustain each month. The FOMO close. Some of the best 0% balance transfer cards have promotional periods that expire on a rolling basis. The window to lock in 18 or 21 months at 0% changes with the market. If you have a balance that qualifies, the link is below. The math works in your favor, but only if you act before the promo windows close. 6 months from now, you could be $540 lighter in interest charges, or you'll have paid another $540 to the bank with nothing to show for it. That's the hidden cost of carrying a balance and the exact math on eliminating it. But there's a related question I haven't touched. What if you're not carrying a balance, but you're earning the wrong rewards? The gap between a 1% card and a 4x card on the same spending is often larger than the interest you just calculated. That math is next week. Subscribe and you'll get it the day it drops. If this saved you from a $1,000 plus interest bill, the like button is right there. 2 things. The card match guide at cardsmadesimple.com/match. 90 seconds. Tells you whether you should focus on paying down debt or optimizing rewards first, and which card wins for your situation. And episode 2 of Fine Print Exposed is already queued. The hidden costs in your credit card's fine print that cost you money even when you're paying in full. That's next Wednesday.